The IRS has just overhauled the retirement rules for 2026, and if you aren't aware of these changes, you could be leaving thousands of dollars on the table without even realizing it. We're talking about up to $24,000 in deductions for individual filers and nearly $47,000 for married couples. That's right, $47,000. But here's the catch. These deductions aren't a free-for-all. They phase out at certain income levels, and there are hidden traps that could actually end up costing you more than you save. Take my client Robert, for example. He's a 72-year-old retired teacher, careful, methodical, the kind of person who plans ahead. He knew about the new $6,000 senior bonus deduction and was excited about optimizing his taxes. He thought he had it all figured out, but one critical misstep ended up costing him over $4,000 in taxes and triggered a Medicare penalty that still costs him $300 every single month. What did he do wrong? I'll reveal the exact mistake in just a few minutes. So write down this timestamp because some of you are likely making the same error right now without realizing it. Stay with me because I'm breaking down the exact numbers and strategies you need to know before tax season kicks off on January 26th, which is just days away. More importantly, I'll show you how to avoid the kind of catastrophic mistake that's quietly draining retirees of thousands every year. For those of you new here, welcome. I specialize in breaking down complex tax and financial topics into actionable strategies you can actually use. No confusing jargon, no fluff, just real money-saving information. And if you've been following along, you know that today's topic could literally mean the difference between keeping thousands in your pocket or handing them straight back to the IRS. The One Big Beautiful Bill Act has completely changed the retirement tax game for seniors in 2026. Many people assume that taxes automatically go down once you retire, but with these new brackets and deductions, the rules have flipped entirely. The reality is financial stress in retirement rarely comes from poor market returns. It comes from misunderstanding taxes, mismanaging income planning, and mistiming distributions. One wrong move, one overlooked form, one miscalculated step, and you could lose thousands of dollars without even realizing it until it's too late. Now let's go back to Robert for a moment. He's not careless. He wasn't ignoring his finances. On the contrary, he's the kind of person who reads, researches, and plans. In 2024, he made a decision on the advice of his financial advisor to convert a substantial portion of his traditional IRA to a Roth IRA. On paper, this was a reasonable strategy. Roth conversions can be brilliant tools for long-term tax planning. You pay taxes now at today's rates and then enjoy tax-free growth and withdrawals. Robert was excited about the $6,000 bonus deduction he would also qualify for as a senior, and everything seemed to make perfect sense. Fast forward to 2026, and Robert opens his Medicare statement. His monthly premium has skyrocketed from $174 to almost $480. That's an extra $300 per month or $3,600 a year just gone. And here's the kicker. Nobody had told him this spike could have been avoided. Nobody explained the 2-year look-back rule or that a simple form could have prevented this. Robert's story isn't unique. It's happening to real people every day, and most have no idea that the system allows them to appeal these charges. Before I dive into exactly what Robert did wrong, it's important to understand the new deductions that set the stage for his problem. Starting with the basics, for tax year 2025, which you'll file in 2026, single filers get a standard deduction of $1,600. Married couples filing jointly get $30,200, and heads of household get $24,500. These are the baseline numbers everyone gets, and they've been adjusted upward for inflation. But if you're 65 or older by December 31st, 2025, there's a brand new senior bonus deduction. For individuals, that's an extra $6,000. For couples where both are 65 or older, it's $12,000. Unlike a tax credit, this deduction reduces your taxable income, which depending on your tax bracket could save you between $1,200 and $2,400 for an individual or double that for a couple. And this isn't the only deduction seniors qualify for. The age deduction that's existed for years still applies, stacking on top of the standard deduction and the new senior bonus. Layered together, these deductions create a shield against taxes that can literally protect nearly half of your retirement income from federal taxation. Let's do the math. Married couples filing jointly start with a $32,200 standard deduction. Add the age deduction of $3,300 and then layer on the new senior bonus of $12,000. That totals $47,500 in deductions. For a married couple bringing in $90,000 annually in retirement, that means only $42,500 of that income is actually taxable. If you're single, the stacking still adds up. $16,100 standard deduction, $20,500 age deduction, and $6,000 senior bonus equals $24,600 of protected income. That means a single retiree making $50,000 would only pay federal income tax on around $25,000. This is the difference between struggling to get by and having a comfortable retirement. But here's the critical trap, and this is exactly where Robert went wrong. These senior bonuses phase out for higher earners. Single filers who earn over $75,000 and married couples over $150,000 begin losing the deduction at a rate of $60 for every $1,000 over the limit. Beyond $175,000 for individuals or $250,000 for couples, the bonus disappears entirely. And filing status matters. Married filing separately disqualifies you. Small income miscalculations or poorly timed distributions can push you over the threshold, triggering cascading consequences like higher taxable Social Security and, most importantly, increased Medicare premiums through the Income-Related Monthly Adjustment Amount, or IRMAA. Let's look at an example. Jane, 67 and single, has a total income of $80,000. The threshold for her bonus deduction is $75,000, putting her $5,000 over. She loses $300 of her $6,000 bonus. It doesn't seem like much, but that $300 can push her taxable income into a higher bracket, increase the portion of her Social Security subject to taxes, and trigger higher Medicare premiums. Meanwhile, Jane's neighbor Margaret, also 67 and earning $73,000, gets the full $6,000 bonus deduction. Small planning decisions make a huge difference, and sometimes earning less can actually leave you with more money in your pocket. This is counterintuitive but true once you factor in the phase-out rules, Social Security taxation, and IRMAA adjustments. Now back to Robert. His mistake was a large Roth conversion in 2024. The conversion spiked his adjusted gross income from around $60,000 to $180,000 for that year. Even though his 2026 income returned to normal, Medicare uses a 2-year look-back for premiums. That spike triggered the IRMAA adjustment, tripling his Part B premium. But here's the good news. There's a way to fix it. Filing Form SSA 44, the life-changing event form for IRMAA, allows you to appeal and reduce your premiums retroactively if your income has dropped. Robert filed the form, submitted his 2023 and 2025 tax returns to show his normal income, and within 6 weeks his premiums were adjusted back down, saving him over $3,000 a year. The lessons are clear. Any large one-time income event like a Roth conversion, inheritance, capital gains, stock sales, or property sale could impact your Medicare premiums 2 years later. You need to be proactive, check your statements, and file SSA 44 if your income has dropped. And when it comes to claiming the senior bonus deduction, it's simpler than you think. Enter your date of birth on Form 1040 or 1040 SR, and the IRS automatically applies the age deduction and senior bonus. Electronic filing with direct deposit is fastest for refunds, typically delivering money within 10 to 14 days, compared to 6 to 8 weeks for paper filing. Accurate information is critical. A simple clerical error could cost thousands, so double-check birth dates, Social Security numbers, and filing status. Ultimately, the new rules for 2026 create both incredible opportunities and potential pitfalls for retirees. With proper planning, understanding the senior bonus deduction, age deduction, and phase-out rules, and being mindful of the IRMAA trap, you can protect tens of thousands of dollars, lower taxes, and avoid unnecessary Medicare premiums. Robert's story proves it. One misstep can cost thousands, but with the right knowledge and a few simple actions, you can reclaim that money and secure a more comfortable retirement.